Pause what you're doing for now. If you receive Social Security or expect to, what I'm about to share may affect your budget by thousands of dollars every year over time. And most retirees have no idea this is even happening to them. We're talking over $3,200 lost quietly, legally, every year. This isn't just a glitch. This isn't simply a mistake. This is the tax code. And 7 states are still applying it in 2026. Stay with me, because by the end of this video, you'll know exactly which states are collecting your money, exactly how much they collect, and most importantly, what practical steps you can take now. Let's begin with that. Here's what recently occurred. For decades, retirees across America assumed that once they reached retirement age, their Social Security benefits were theirs, free and clear. After all, you contributed to the system throughout your working life. 30, 40, sometimes 50 years of payroll taxes. That money was meant to return to you later. And at the federal level, yes, some of it can be taxed depending on your income. That's a different topic. But here's where things get worse. In addition to federal taxes, 7 states in 2026 still apply their own state income tax to your Social Security benefits as well. Exactly right. While many states have already removed this tax or never used it, 7 states are still reaching into retirement checks and taking a portion from benefits in 2026 for some. And the amounts are not tiny. We're talking hundreds, even thousands of dollars each year, depending on where you live and how much you collect. Now, a few states have changed recently. A few are phasing out this tax, but those phase-outs move slowly indeed. The exemptions carry strict income limits, and millions of retirees still feel the impact in 2026 today. This is significant, and it directly affects your financial security. So, let's go through it state by state so you understand exactly where you stand. These are the 7 states still taxing Social Security benefits in 2026. Jot notes. Share this with your family because this information matters deeply. First, Colorado does tax Social Security benefits, but the details matter. If you are under 65, a limited deduction may be available. Once you turn 65, the deduction becomes more generous. But if your income exceeds certain limits, you may still owe state tax on part of your benefits overall. Colorado's income tax rate is a flat 4.4% today. That may not seem huge until you run numbers. If $15,000 of your Social Security benefit becomes taxable at the state level, you could lose $660 immediately from your check. Second, Connecticut is among the more aggressive states on this list overall for retirees. If your adjusted gross income exceeds $75,000 for single filers, or $100,000 for married couples filing jointly, your Social Security benefits are taxed at the state income tax rate there too. Connecticut's highest rate reaches 6.99%. For a retiree with average benefits sitting just above that income threshold, the hit can easily run from $1,000 to $1,500 each year. Connecticut has discussed expanding exemptions, but as of 2026, those income caps still remain in place. If you're above them, taxes apply. Third is Minnesota. Minnesota is one of the toughest states for retirees on this list. The state taxes Social Security benefits as ordinary income, with rates ranging from 5.35% all the way up to 9.85% for some earners. Minnesota does offer a special Social Security subtraction, but that exemption phases out at fairly modest income levels for many. Single filers above roughly $62,000 and married couples above $79,000 begin losing that exemption fairly quickly now. For middle-income retirees in Minnesota who don't qualify for the full subtraction there, we're talking possible state tax bills of $1,500 to $2,500 per year on those benefits alone there. This is one of the biggest reasons Minnesota often tops lists of the least retiree-friendly states overall for retirees. Fourth, Montana taxes Social Security benefits, and the exemptions there are notably low still. Single filers above just $25,000 and married couples above $32,000 can end up with their benefits taxed there too sometimes. Montana's income tax rate peaks at 6.75% overall. What makes Montana especially tough is those low income thresholds. You don't have to be wealthy to get hit there. A modest fixed income can push you directly into taxable territory. Fifth, New Mexico. New Mexico has been making progress. The state has expanded exemptions over recent years. As of 2026, single filers below $100,000 and married couples below $150,000 are currently exempt from state Social Security taxes today. But there's a catch. If you exceed those limits, New Mexico taxes your benefits with rates up to 5.9%. And for retirees with pension income, investment income, or part-time work layered on top of Social Security, reaching that $100,000 single filer threshold is more common than you might think. Sixth is Rhode Island. Rhode Island taxes Social Security, but offers an exemption that fades out at higher incomes. If you're below full retirement age, or if your income exceeds the state's threshold, roughly $88,950 for single filers in recent years, you're entering taxable territory. Rhode Island's income tax rate runs from 3.75% to 5.99%. For retirees just above the exemption cutoff, this often means $400 to $900 yearly in extra state tax burden overall. Seventh is Vermont. Vermont closes out our list, and it's another high-tax state retirees need to watch carefully closely. Vermont taxes Social Security benefits, with exemptions available only for lower-income filers overall. Single filers below $45,000 and married couples below $60,000 qualify for a full exemption there. Above those thresholds, your benefits are taxed at Vermont's income tax rates, which can reach 8.75% there too. For a Vermont retiree receiving $20,000 in Social Security each year with income above the exemption limit, a state tax liability over $500 on those benefits is very realistic indeed. Hold. Take that in. 7 states, real dollars, real consequences. And if you're finding this useful right now, do me a quick favor. Tap that like button. It helps more retirees discover this information when they need it most. Let's discuss what this really means for real people everywhere. The average Social Security benefit in 2026 is roughly $1.87 per month, or about $22,884 annually today. Now, not every dollar of that is automatically subject to state tax. It depends on your total income, your filing status, and the specific rules in your state. But let's use a realistic case. Imagine you're a married couple in Minnesota. Combined Social Security income totals $38,000 per year. You also receive a modest pension, maybe $25,000 yearly. Total income reaches $63,000. You're above Minnesota's phase-out threshold there. A substantial portion of your Social Security is now taxable at the state level. After applying the top rate, you could face $2,000 to $2,800 in state tax just on your Social Security benefits each year there. Add to that the federal tax layer because yes, up to 85% of your benefits can be federally taxed depending on income, and your retirement income is getting squeezed from 2 directions at once. Now picture a single retiree in Vermont. Social Security totals $20,000. A modest IRA withdrawal of $15,000. Income totals $35,000. They're below Vermont's full exemption threshold, but only barely. Any added income, a part-time job, selling stock, could push them over. This is a trap, a financial trap built into the tax code, and most retirees do not see it coming until it hits them. Some retirees lose over $3,200 per year when you factor in both the state and federal tax layers on those benefits there. That's roughly $260 every month. Lost. For someone on a fixed income, that is not a minor amount. That is food. That is medicine. That is the difference between financial stability and stress today. And here's the key point. And this is fully legal. States are allowed to do this legally. But that does not mean you must sit back and absorb the hit without a plan. Stay right there, because next I'll explain exactly what you can do about it from here now. Knowledge without action is only frustration. So, let's discuss strategy. Here's what you can really do if you live in one of these 7 states, or are planning retirement and want to avoid this hit altogether later too. Strategy number 1. Consider reviewing relocation options. This is the main one, and I know it sounds drastic, but hear me out. 41 states plus Washington, D.C. do not tax Social Security benefits at the state level. 0. None. States like Florida, Texas, Nevada, Tennessee, and Wyoming have no state income tax whatsoever there. Other states like Illinois, Pennsylvania, and Mississippi exempt Social Security from state taxes. If you pay $2,000 or $3,000 per year in state taxes on your benefits, and you stay retired for 20 or 25 years, that's $40,000 to $75,000 across your retirement timeline overall there too. The numbers on relocation, especially to a lower-cost state that also doesn't tax Social Security, can be truly transformative over time overall. This is a discussion worth having with your financial advisor. Strategy number 2. Manage income carefully. Many of these state tax exemptions include income thresholds. That means your amount of taxable income in a given year determines whether your Social Security gets taxed there too. Work with a tax professional to manage what's called provisional income carefully. That's total income figure used to calculate how much of your Social Security is taxable. Strategies like Roth conversions, pre-retirement timing, IRA withdrawal timing, or managing capital gains can help keep your income below critical thresholds in many cases. Strategy number 3. Know the exemptions well. Each state on this list has specific exemptions tied to age, income, or filing status. Study them, read them, apply for them. Some retirees pay taxes they do not legally owe simply because they never learned about the exemption or filed it incorrectly on their return there. A skilled CPA who specializes in retirement tax planning is worth their weight in gold here. Strategy number 4. Stay informed about legislative changes. Several states on this list, including Connecticut and New Mexico, have expanded exemptions in recent years because of political pressure and demographic shifts there. Colorado and Connecticut in particular have had ongoing debates about eliminating this tax entirely altogether. Changes can happen, and if your state eliminates the tax, you need to know immediately so you can adjust withholding, estimated payments, and planning accordingly as needed for your budget. Sign up for state tax authority updates, follow retirement financial news, and subscribe to Senior USA News because we cover these changes as they happen closely. Here's what I'm watching ahead, and this changes everything for retirement planning in the years to come. Political pressure to eliminate Social Security taxation at both the state and federal levels is growing quickly now. At the federal level, Congress has renewed discussions about raising the income thresholds at which Social Security becomes taxable for benefits overall. Those thresholds, surprisingly, have not been meaningfully updated since 1984. Back in 1984, very few retirees reached those thresholds then. Today, because of inflation and rising benefit amounts, most Social Security recipients pay some federal tax on those benefits now too. That creates a political pressure point. At the state level, the trend is obvious. States are backing away from taxing Social Security. We've seen multiple states eliminate or sharply reduce this tax over the past decade. The question is not whether the remaining 7 states will follow. The question is timing. But here's the harder truth. When changes occur, they rarely happen automatically for you. You have to notice they happened. You have to respond to them. That's exactly why staying informed is not optional during retirement. It is a critical survival skill. This is why I make these videos, and this is why you should be subscribed to Senior USA News. Let's wrap this up. In 2026, 7 states still tax Social Security benefits there. Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Vermont. Depending on where you live, your income level, your filing status, and your total retirement picture, you could lose anywhere from several hundred to over $3,200 per year there. That is real cash. Your money you earned across a lifetime of work. The system is not going to alert you. Your state is not going to mail you a note saying, "Hey, here's how to lower your tax bill." That's not how it works. You have to understand the rules, you have to plan for them, and you have to stay ahead of these changes. Here's your action plan beginning today. First, find out if your state appears on this list. If it is, review your last 2 years of state tax returns and see exactly how much you paid in Social Security taxes there. Second, book a consultation with a retirement-focused CPA or financial advisor soon. Ask specifically about your provisional income and your state's Social Security tax exemption rules. Third, if you're in the pre-retirement planning phase and have flexibility about where you retire, run the relocation numbers carefully. The tax savings over a 20-year retirement can be truly life-changing. Fourth, stay informed. Tax laws change, exemptions expand, new legislation passes, and retirees who win are the ones who pay attention. And if this video brought you clarity, if it opened your eyes to something you didn't fully understand before, then do 3 things right now. Tap that like button. It takes 1 second, and it helps thousands of other retirees find this information. Leave a comment underneath. Tell me, are you in one of these 7 states? Are you affected by this tax currently? I read every comment and want to hear from you today. And subscribe to Senior USA News because this channel exists for one purpose: to give you the financial knowledge you need to protect your retirement, income, and future every day. The information exists out there, but most people don't have it. Now you know. Disclaimer: this video is for educational and informational purposes. It does not provide legal, tax, or financial advice. Tax laws vary by individual circumstances and change frequently. Please consult a qualified tax professional or financial advisor before making decisions based on this content today.